Hi, welcome to part 4 of my Trading Academy series. Before proceeding to this part 4, watch part 1, Candlestick Trading Strategy, part 2, Candlestick Pattern, part 3 : Market Structure for Sequentiality. In this part 4, I will cover time frames and top-down analysis. As a price action trader, your primary time frame is the 1H, the 4H and the daily. Price action works on bigger time frames. If you try to trade pin bars or engulfing bars on the 5-minute time frame, you will lose your money, because there is lot of noise on smaller time frames, and the market will generate lot of false signals because of the hard battle between the bears and bulls. Besides, there is no successful price action trader who focuses on one time frame to analyze his charts. Maybe you have heard of the term top and down analysis, which means to begin with bigger time frames to get the big picture, and then you switch to the smaller one to decide whether to buy or to sell the market. Let's say you want to trade the 4 hours chart, you have to look at the weekly chart first, and then the daily chart. If the weekly and the daily charts analysis align with the 4 hours chart, you can then take your trading decision. And if you want to trade the 1H chart, you have to look at the daily chart first. This is a critical step to do as a price action trader, because this will help you avoid low probability trading setups, and it will allow you to stay focused on high probability price action signals. Through our top-down analysis, we always start with the bigger time frame, and we look for to gather the following information: the most important support and resistance levels. These areas represent turning points in the market. If you can identify them on the weekly chart, you will know what is going to happen when the price approaches these levels on the 4 hours chart. So you will decide either to buy, to sell, or to ignore the signals you get from the market. The market structure. The weekly analysis will help you identify if the market is trending up or down, or it is ranging, or choppy market. In general, you will know what the big investors are doing, and you will try to find a way to follow them on the smaller time frames using my price action strategies. The previous candle, the last candle on the weekly chart, is important, because it tells us what happens during a week, and it provides us with valuable information about the future market move. When you identify these points using the weekly chart, you can now move to the daily chart or the 4 hours chart and try to gather information such as the market condition, what the market is doing on the 4 hours time frame, is it trending up or down, is it ranging, or is it a choppy market? What are the most important key levels on the 4 hours or the daily time frame? This could be support and resistance, supply and demand areas, trend lines. Price action signal, are candlestick patterns that will provide you with a signal to buy or short the market. This could be a pin bar, an engulfing bar, or an inside bar. Let me give you an example to help you understand why it is important to adopt the top-down analysis concept in your trading method, and what is going to happen if you don't look at the bigger time frame before switching to your primary chart. Look at the illustration below. As you can see in this weekly chart above, we have gathered 2 important points that will help us decide what to do on the daily time frame. The first point is that the market approaches to an important weekly resistance level that will represent a hot point in the market. The second information is the rejection from this key resistance level. As you can see, the price was rejected immediately when it approaches the level. This indicates that there are sellers there and they are willing to short the market. What confirms our analysis is the formation of the inside bar false breakout patterns that indicates a reversal. Now let's switch to the daily time frame to see what is going on in the market. On the daily chart, we have a clear pin bar candlestick pattern that indicates a bullish signal. If you focus just on one time frame to make your trading decision, you will buy the market, because there is a clear pin bar signal. But if you analyzed the weekly chart, you would know that there is a very powerful key level that will stop the market from going up. So, it's better to think of selling the market if there is a clear signal rather than to buy it. Look at what happened next. As you can see, the top-down analysis works. The pin bar candlestick signal didn't work, because the weekly resistance level was a powerful turning point that reversed the market direction. If you want to trade price action based on one time frame, I highly recommend you to stop trading, because you will end up losing your entire trading account, and you will never become a successful trader. Trading counter trends is very profitable as well, but without the top-down analysis, you will put yourself in troubles. Let me give you another example to show how you can trade counter trends using your price action trading setups in combination with the top-down analysis concept. As you can see in the chart above, price are at a weekly resistance level. Buyers were rejected twice from this level, which indicates that the market is at a hotter point and it is likely to reverse. What you can do as a price action trader is to switch to the daily time frame to look for a selling opportunity. If you can find a price action setup near the weekly resistance level on the daily time frame, this is going to be a high probability setup to take into consideration. See the example below. The daily chart above confirms our weekly analysis. As you can see, there is a clear bearish signal near the weekly resistance level. The pin bar was rejected from that level, and there is also the formation of an inside bar false breakout. This is a clear indication of a trend change. See what happened next. The example above shows that counter trend works if it is well mastered. It is a contrarian approach that requires experience, so if you are a beginner, I highly recommend you to stick with the trend. Try to practice as much as you can the top-down analysis concept with the trend, and when you master trading with the trend, you can then move to trade high probability counter trend setups. There are many approaches used to time the market turns and plan trades. The most of these approaches lead to greater confusion and lack of confidence in the results. Keeping the analysis simple is most often the best way to go, and top-down analysis is one of the easiest approaches that I recommend to master if you want to trade the right way. What you have to do right now is to open your charts and try to practice what you learnt in this chapter. Try to identify the market trend using these techniques. It will be a little confusing at the beginning, but with some screen time and practice, you will find it easy to identify the market direction. Next thing to master is trading strategies and tactics. In the last chapters you learned 3 important aspects of price action trading. The first aspect is the market trends. You know how to identify the market trend using multiple time frames analysis. You know how to differentiate between trending markets and range bounds markets. And you understand how each market moves. The second aspect is the level. You learned how to draw support and resistance, and how to draw trend lines. This skill will help you better enter the market in the right time. The third aspect is the signals. You have seen different candlestick patterns. You understand the psychology behind its formation, and the message they send you. These 3 aspects, which are the trend, the level, and the signal, are what we will use in our trading approach to make money trading any financial market. I mean that when you open a chart, you will try to answer 3 important questions. 1. What the market is doing. Is it trending, consolidating, or is it a choppy market? If it is trending, you know how to identify if it is an uptrend or a downtrend. If it is a ranging market, you will see that it is trading horizontally between 2 boundaries. And if it is a choppy market, you close your chart and you stay away. 2. What are the most powerful levels in this market? If the market is trending up or down, or it is ranging, you will try to find the most important support and resistance levels. These levels are the best zones where you can buy and sell the market. 3. What is the best signal to enter the market? The best signal to enter the market means the right time to execute your trade. And this is what you will learn in the next chapter. The next thing we will discuss is the pin bar candlestick pattern strategy. The pin bar candlestick is one of the most famous Japanese candlesticks. It is widely used by price action traders to determine reversal points in the market. In this section, you will learn in detail how to identify potential pin bar signals, and the conditions needed for high probability setups. A pin bar is a chart candlestick. It is characterized by a very long tail that shows rejection and indicates that the market will move in the opposite direction. The area between the open and close is called the real body. Typically all pin bars have a very small real body and a long shadow. A bullish pin bar is known for its lower wicks, and the bearish one is characterized by long upper wicks. The color of the candlestick is not quite important, however. Bullish candles with white real body are more powerful than candles with a real black body. On the other hand, a bearish pin bars with black real bodies are more important than the ones with white real bodies. See how pin bars look like below. How to identify pin bar candlestick setups. To be honest, quality price action setups don't exist in the market, because you will see that sometimes you can find a high probability setup, you feel very excited about it and you take your trade with confidence, but at the end, you will be frustrated because the signal fails for unknown reasons. That happens a couple of times, because the market doesn't move due to pin bar formations. What moves the market is the law of supply and demand. Let me give you an example. If you identify a quality pin bar candle near a support key level in an uptrend market, this is a powerful buying signal to take. You shouldn't ignore it, but if the amount of money that buyers put in this trade is less than the amount of money that sellers risk in the same trade, the market will not go in your predicted direction. If the signal fails, it doesn't mean that your analysis is wrong, or pin bars don't work. It is just because the market didn't validate your decision. Therefore, you accept your loss, and you look for another opportunity. You may ask yourself, why should we look for quality pin bar setups if the market doesn't respect them? As you know, trading is a game of probabilities. There is no certainty. This is why you should evaluate your pin bar setups from multiple angles, and the fact that you are looking for quality setups means that you are trying to put the probabilities of success in your favor, which is the right mindset of successful traders. To determine whether or not a pin bar is worth trading, this price action signal should respect the following criteria. The pin bar formed in bigger time frames such as the 4-hour or daily time frame should be taken into consideration, because if you look at smaller time frames, you can easily spot a lot of pin bar signals. These setups should be ignored, because smaller time frames generate a lot of false signals. See the illustration below. The pin bar formed in line with the direction of the market is more powerful than the one which is formed against the trend. If you can identify a clear trend, that means that you know who is in control of the market. The formation of this candlestick pattern with the trend makes it so effective. See the chart below. As you can see in the chart above, bullish pin bars that were formed in line with the uptrend work, and they should be taken into consideration. But the bearish ones that were formed against the trend should be ignored. The anatomy of a pin bar is important as well. You have to make sure that the candlestick is a pin bar by looking at the distance between the real body and the tail. Pin bars with longer tails are more powerful. Next thing to discuss is the psychology behind the pin bar candle formation. Pin bars are formed when prices are rejected. This rejection doesn't indicate a reversal signal, because this price action setup can form everywhere in your chart. The most important areas to watch when trading pin bars are major key levels such as support and resistance, supply and demand zones, and moving averages. The formation of this candlestick chart pattern in these levels give a clear idea about what happens in the market. If the rejection was near a support level, for example, this is an obvious indication that the bulls are more powerful, and they are willing to push the market to go upward. See the chart below. If the formation of this candlestick occurs near a resistance level, it indicates that the bears reject prices, and prevent the bulls from breaking this level. So, this means that sellers are willing to push the market downward. See the chart below. If you understand the psychology behind this price action pattern formation, you will be able to predict what is likely to happen in the future, and you will make good trades based on high probability pin bar signals. Next thing to discuss is trading the pin bar candlestick with the trend. If you are a beginner trader, I highly recommend you to stick with the trend, because pin bars that occur in trending markets offer good trading opportunities with high risk/reward ratio. When you master trading it with the trend, you can then move to trade range-bound markets or even counter trends. This strategy is simple. You start by identifying a clear uptrend or downtrend, and you wait for a pin bar to occur after a pullback to support or resistance level. See the example below. 1. The pin bar is well formed, and it is in line with the direction of the market. 2. The rejection occurred in a major key level which represents a hot point in the market, resistance level. 3. The risk to reward ratio is good, and it is worth trading. Sometimes, even if the market is trending, we can't draw support and resistance levels, because prices move in a certain way which we can't spot static key levels. If you are in this situation, you can use the 21 moving average, which will act as a dynamic support in an uptrend market and a dynamic resistance in a downtrend market. See the illustration below. As you can see in the chart above, the market was trending down. Using the 21 moving averages helps us to identify dynamic resistance levels and high probability pin bar setups. See another chart below. The 4-hour chart above illustrates how the 21 moving average could help us find key points in the market. When prices approach the moving average, the buying pressure takes place in the market, and the price goes up. The pin bar signal is clear on the chart, because the trend is bullish. The price action setup has a bullish anatomy as well, and the rejection from the 21 moving average is a confirmation signal to buy the market. Next thing to discuss is trading tactics when we identify the trend, uptrend or downtrend, and the level, support or resistance. And we find a pin bar near these levels in line with the direction of the trend. The second step is to know how to enter the market based on this candlestick pattern. According to my experience, there are different entry options when it comes to trading pin bars. It all depends on the candle anatomy, the market conditions, and your money management strategy. 1. The aggressive entry option. This method consists of entering the market immediately after the pin bar closes without waiting for a confirmation. This strategy will help you catch the move from the beginning, because sometimes the price goes higher after the close of the pin bar, and if you are not in the market, the trade will leave without you. See the example below. The chart above shows how an aggressive entry could help you to execute your trade in the right time without being left by the market. And as you see, we took this trade because we had 3 important elements. The trend, the market was trending down. In this case we look for selling opportunities. The level, in this chart we had a support level that becomes resistance. The signal, a clear pin bar, was formed after the retracement back to the resistance level. When you have these 3 elements in the market, you just place your trade after the close of the pin bar, and your stop loss above the long tail. Your profit target will be the next support level in case of a downtrend. These 3 elements are quite enough for you to find high probability entries in the market. The conservative entry option. This strategy consists of entering the market after 50% of the range bar retracement. This strategy sometimes will work and it gives you more than 5-to-1 risk/reward ratio, and sometimes the market will leave without you. See the illustration below. The illustration above gives us an idea about the power of conservative entries. As you can see, this entry method helps us decrease our risks and increase our rewards. The trade above has more than 5-to-1 risk/reward ratio. One trade like this every month is quite enough to generate a decent income. See another chart below. One of the drawbacks of this entry option is that the market sometimes doesn't retrace to 50% of the range bar, which will make you feel frustrated because the market will move to the profit target without you. There is no wrong or right entry option, they both work great, but with screen time and experience, you will be able to decide whether to trade aggressively or conservatively. Next thing we will talk about is trading pin bars with confluence. Confluence happens when many technical indicators generate the same signal. This trading concept is used by price action traders to filter their entry points and spot high probability signals in the market. It doesn't matter if you are a beginner or advanced trader, trading with confluence is a must, because it will help you focus on quality setups rather than quantity, and it will enhance tremendously your trading performance. Confluence means combination or conjunction. It is a situation in which two or more things join or come together. For example, if we are looking for a pin bar signal, we need to find other factors of confluence to confirm our entry. We are not going to take any pin bar that we find on our chart. Factors of confluence. The trend. It is one of the most important factor of confluence. This is the first thing that most successful traders look for on their charts. You can't trade any setup without identifying if it is in line with the direction of the market or not. A bearish pin bar in a downtrend is more powerful signal than the one in a range-bound market. Support and resistance levels and supply and demand areas. These major levels have a significant importance in the market, because all big participants watch these specific areas. Moving averages. I personally use the 8 and 21 moving average. This technical trading tool acts as dynamic support and resistance, and it is a very important factor of confluence in trending markets. Fibonacci retracement tool. I use the 61% and 50% Fibonacci retracement to find the most powerful areas in the market. Trend lines. Drawing these lines on your charts give us an idea about the market direction and help us find the most important reversal points in the market. When you are analyzing your chart, you are not obligated to find all these levels to determine whether the trade is valid or not. If you can find just one or two factors of confluence that come up together with a good pin bar setup, this is quite enough to make a profitable trade. For example, an obvious pin bar signal near support or resistance level in line with the direction of the market. See the illustration below. In the example above, we have a high probability setup with 4 factors of confluence. 1. The trend. The market is trading up, which means that we have to follow the trend and look for a buying opportunity. 2. The level. The support level is an important key level in the market. As you can see, price broke out of the resistance level that becomes support and pulled back to it. 3. The signal. The formation of the bullish pin bar after the retracement back to the resistance level that becomes support. 4. Another signal, the rejection of the pin bar from the support level, and the 21 moving average that acted as a dynamic support level. All these factors work together to give us powerful trading signal to buy the market. See another example. The example below shows 4 confluent levels that indicate a powerful trading signal. The first factor is the bullish trend, and the second one is the resistance level that becomes support. The third one is the 21 moving average that acts as a dynamic support level. And the last factor is the pin bar formation near these levels in line with the bullish trend. Watch my next videos on pin bars trades examples, trading pin bars in range-bound markets.